Welcome, everyone. Welcome to the third session on public sector accounting. If you haven't watched the past two sessions, please, you are missing out. So please go watch the past two sessions. I share a lot of things. I'm all for you to pass your public sector accounting exam. And I know you can do it. You can succeed in passing your public sector accounting exam. But first off, if you haven't subscribed to our YouTube channel, please do. We have, everything related to the ICA. All the topics, you can find them on the channel. So please subscribe, hit the notification bell so that anytime I post a video or a lecture, you'll be the first to receive it. Won't you like to? Yeah. So you can watch it quickly and, be ahead of the game. Then we also have social media platforms. So on Facebook, we are Pinnacle Professional College. On Instagram as well, Pinnacle Professional College. You should find us, like, share, comment on our page. Tell us how amazing we are. Give us feedback and let us know what you would love to see. Okay, in today's objective, we'll be talking about public sector accounting techniques. We'll be talking about the basis for recognition and measurement. We'll be talking about commitment accounting and other techniques of accounting and any other related matters as well. We'll touch on it. So let's dive right into it very, very quickly. So what are techniques of public sector accounting? When we say techniques of public sector accounting, what do they mean? Technique of public sector accounting refers to the peculiar systems used in achieving the goals of the public sector or the objectives of the public sector. These are the special systems that are used in achieving the goals or objectives or aims of the public sector. It is an additional method that is added to a selected basis of accounting in order to achieve a special aim. We talked about basis of accounting in the previous lecture. So if you haven't watched it, you should go and watch it. So the techniques of public sector accounting is basically an additional method, right? An additional method that is added to the selected basis of accounting to achieve some public sector organizational goals. And these objectives could be, you want to manage the budget, you want to restrict spending, you want to be able to properly plan and categorize government activities. So these are all aims or objectives of public sector organizations. Very, very important. They have types. So what are the types of these techniques? What are these techniques at all? The main techniques that are used are, number one, budgetary accounting. Number two, fund accounting. Number three, commitment accounting. So what exactly are these things? What exactly are these techniques? Let's find out. So budgetary accounting, it simply refers to the process by which the public sector organization integrate or include budgeted amounts into the financial accounting system for the purposes of budgetary control. Very, very important. So in budgetary accounting, there's this philosophy where public sector organizations believe that it's important to control spending. And so they include budgetary amounts in the financial system so that they can easily compare and control budgetary spend. So that's basically it. So let me read that again. It says budgetary accounting refers to the process by which public sector organizations integrate budgeted amounts into the financial accounting system for the purposes of budgetary control. You are controlling the budget and you are managing it properly. And with this accounting system, right, you are able to compare your actual performance to your budgeted performance. That's one of the main things. And what will be the result of that? You'll be able to do a proper variance analysis. What do we mean by variance analysis? You want to, after comparing your actual performance to your budgeted performance, what is the difference? Is the difference favorable or is it unfavorable? So the budgeted figures are incorporated into the accounting system to facilitate the generation of a report. And this report will be budgeted performance versus actual performance. Very, very key. So that's the whole idea of budgetary accounting. With budgetary accounting, you always include budgetary numbers. So when we say budgetary numbers, at the start of every project, the project team would have an idea of what the numbers they would achieve. So if it's revenue, they have an idea of the revenue they want to achieve. Or in the case of a public sector organization, if it's costs or if it's spent, they'll have an idea of how much they want to spend at the beginning. Okay, then throughout the year, actual spend will begin to trickle in. So you need to compare the actual spend to the budgetary figure to understand whether there are any variances. Very, very important. Very, very important. This is also referred to as what we call vote accounting. Vote accounting. And let's move on to fund accounting. Fund account. Let's move on to fund account. What is fund accounting all about? What is it all about? What is fund accounting all about? It's basically an accounting system for recording resources whose use has been limited by the donor, grant authority, governing agency, or other individuals or organizations, or by law. So it's an accounting system that is used for recording resources, which has been limited, by the donor. For public sector organization, donors will give them money. Grant authorities, governing agencies, they will all give them money, right? That's how they operate. So it's an accounting system for recording those resources that are limited by the donor and these donor agencies, basically. So you are accounting for that pool of funds that has been handed over to you by donors. That's the logic behind it. Here, the emphasis is on accountability. Accountability, how well you are using these funds. Accountability. Is these funds used properly? And, like it says here, it emphasizes accountability rather than profitability, and is used by non-profit organizations and by governments. In this method, a fund consists of a self-balancing set of accounts, and each are reported as either unrestricted, temporarily restricted, or permanently restricted. So the whole idea here is that you are recording resources whose use have been limited, by donor agencies. Once a donor agency gives you money, they might have some restrictions around the usage of the money, and fund accounting looks critically into that. Very, very important. Then let's talk about commitment accounting. Commitment accounting. We are still on the types of the techniques. So this technique recognizes transactions when a decision is made. So when a decision is made, it recognizes the transaction when the decision is made. Which decision are we talking about? When we sign a contract for services, those kind of things. So this technique recognizes transactions when a decision is made. A decision is made to spend, for example, by placing an order or signing a contract for services. Commitment accounting identifies and reserves funds for future payment obligations. It identifies and reserves funds for future payment obligations. So, the way we say, I have this commitment. It means that you set aside some amount of money to take care of some future obligation. That is the whole idea of commitment accounting here. So commitment accounting is an integral part of sound financial management, and it's used by the government a lot. It's used by the government a lot. So public sector organizations would have commitment, and the power of commitment accounting is to identify and reserve funds for future payment obligations. It's like you set aside funds for future obligations, and it helps you to leave the uncommitted balance of budgeted funds available for other expenditures. So the uncommitted balance of funds, you can use it for other expenditures, but the committed ones, you reserve it for future payments. So what is the commitment process all about? What is the commitment process all about? At the commitment stage, it is necessary to verify that the proposal to spend money has been approved. So you want proper approval You want to make sure that the procurement process has been completed. You also want to be sure that the expenditure is recorded under the correct category. You also want to be sure that the proper approved purchase order has been given or has been issued. The institutes prepare, commit, and issue approved purchase orders. Though the PO is very, very important. The PO is very, very important. And we also want to make sure that money was appropriated for the purpose for which you are spending in the budget. You don't want any extraneous expenditures. So you want to make sure that money has been approved. If the money has been approved, then we can go ahead and spend it. And in spending, there has to be a lot of prudence when it comes to spending. So those are some of the processes that you need to make sure when it comes to commitment accounting. What are the advantages of commitment accounting? What are the advantages? It encourages proper planning of activities, because once you've lined out your commitments, you are able to plan. It's just like as individuals, right? You have your commitments. Once you set aside those commitments, you're able to plan your funds or your money properly. So that's the same thing for commitment accounting. It also facilitates the tracking of expenditures. So you can track your expenditure with commitment accounting. And it also helps to prevent overspending. One thing about commitment accounting is it embraces sound financial management. What are the disadvantages? What are the disadvantages of commitment accounting? What are the disadvantages? It may sometimes delay the expenditure process. Because of the whole processes you have to go through before a spend is made. Because there has to be a commitment before a payment is made. And so sometimes it lengthens the process, which causes delays. Because there's also a whole process which basically says commitment must precede payment, it can sometimes lead to year-end spending, year-end rushing. You are rushing to get, your spend approved, So it can lead to end-of-year rush ordering, expenditures, and spending. And in situations where a contract gets cancelled, reversal of entries can also become very, very tedious. Now let's look at basis for recognition and measurement. The basis for recognition and measurement. Let's look at that. Let's understand some key terms. Number one, deferred inflow. A deferred inflow of resources is simply the acquisition of net assets by the government that applies to a future reporting period. So it's basically inflow of resources, which is through the acquisition of net assets. It's by the government. So a typical example would be grant monies that are coming in. Grant monies that are coming in is an example of, grant monies that are restricted to future periods are an example of a deferred inflow. So sometimes you get grant money, but for instance, we are in 2021 now, but they'll tell you this grant money is allocated for 2022. And so it is restricted for future periods, and therefore it's a deferred inflow. It's a deferred inflow. So a deferred inflow of resources is the acquisition of net assets by the government that applies to a future reporting period. Very, very important. A future reporting period. So that grant money is not for now. It's restricted to a future reporting period. That's why we call it a deferred inflow. It's deferred into the future. Then we have deferred outflow of resources. It's simply a consumption of net assets by the government that is applicable to a future reporting period. So example here is deferred charges as well. Then let's talk about assets. Assets, as we know, are We all know the basic definition of an asset, but in the governmental sense or the public sector accounting says, these are resources with present service capacity that the government presently controls. Always remember that for an asset to be an asset, it has to be controlled. So these are resources that the government controls. Then liabilities, these are present obligations to sacrifice resources that the government has little or no discretion to avoid. So these are financial obligations or obligations that the government might have. Then let's talk about revenue. Revenue is simply an inflow which increases the net assets of an entity. Then an expense is an outflow which decreases the net assets of an entity. Very, very simple definitions. Very, very simple definitions. Very, very simple definitions. Yeah, so it's getting interesting. I hope you are following along with me. And I'll take you through this bit by bit as I've always promised. Now let's talk about the basis of measurements, right? We said we'll talk about that in the objectives of this presentation. So the basis of measurement, let's look at assets. How do you measure assets? Number one is the historical cost principle, where you record assets at their historical costs, even if they have significantly increased over time. So when you go into the balance sheets, the items recorded there in the non-current assets, you see that, for example, plant, PP&E, property, plant, and equipment is recorded at historical cost. You are recording it at their historical cost, even though the assets might have increased in value. Then you have replacement costs. This is a term that refers to the amount of money a business must currently spend to replace an essential asset. So the cost you have to incur to replace an asset, that's the replacement cost. So if, let's say, you have an asset like a car, right? And you have to replace it for some reason, the historical cost of the car might be 20,000, but you replacing it might be 25,000. And so that would be the replacement cost. You have value in use. Value in use focuses on net present value, net present value. And I defined it here as is the net present value of a cash flow or other benefits that an asset generates for a specific owner under a specific use. So it's a net present value. When we say net present value, we are looking at the future cash flows that accrue to the assets discounted to the present value. Discounted to the present value minus the cost of investment. That's net present value. Net present value is the future cash flow that accrues to the assets or whatever project it is, discounted to the present value minus any cost that invested into the project or into the asset. Then you have market value basis. This is the fair market value of a business or on assets that will be paid to the owner upon sale. So this is the market value basis. Is basically the price on the market. The formula for determining the fair market value includes business worth and assets in the current financial market. So it's basically what the thing is selling for on the market as of today. Very simple, very simple. Then let's look at the basis of measurements for liabilities. And the liabilities as well, you also have historical cost again. Historical cost again. Under the historical cost principle, most liabilities are to be recorded on the balance sheet. On the balance sheet at their historical costs. Again, you can record liabilities at their historical costs. You also have market value. Liabilities can also be valued at market value when they are traded on an organized market. You can also value them at market value or at fair value when they are traded on an organized market. They also have the cost. So these are the two I want to touch on now: cost of fulfillment, cost of release. Now let's look at cost of fulfillment. The cost of fulfillment refers to all the costs that an organization will incur in fulfilling the obligations represented by the liability. So every cost that you incur in fulfilling an obligation or a liability is referred to as the cost of fulfillment. referred to as the cost of fulfillment. They also have the cost of release. The cost of release is simply, this refers to the amount that relates to an immediate exit from an obligation. So if someone wants to, or an organization wants to immediately take itself out from an obligation, that is referred to as the cost of release, the cost that they will incur to release themselves or to take themselves out of an obligation. That is the cost of release. And this could either be the amount that the creditor will accept in settlement of the claim. So this could be settlement costs. And this would also be, it could also be transfer costs to, shift the liability from one obligator to another, from one obligator to another. So I said here that this could either be the amount the creditor will accept in settlement costs, or someone, an external party, will charge to accept the transfer of liability from the obligator. So that's the whole idea of measuring liabilities, the basis of measurement of liabilities. We've talked about the basis of measurement of assets, and these are the basis of measurement of liabilities. So that is where we'll end it for today. Thanks for sticking and staying with me. I hope you are learning so much. I can't wait to see you pass your exam. Kindly subscribe and hit the notification bell if you haven't, and have a wonderful, wonderful day. Thank you.